Welcome to the Kevin Davis Insurance D&O Q&A Liability webinar. My name is Sherry Branson, and I'm your host today. My main presenter is Kevin Davis, the president of Kevin Davis Insurance. Welcome, Kevin.
Hi, Sherry. How you doing?
Great, great.
That's good. There you are.
Yes. Sorry about that. There was a little bit of a delay. And Kevin, we received so many great questions in June in our last Q&A webinar that we're doing another session today.
Oh, yeah, I'm looking forward to it. It's a lot of great questions today, too.
Yes. And I just wanted to welcome everybody to our webinar today. We have a lot of new brokers that are joining us, and we received some really good questions that we hope to get to today. And if you have any new questions during today's session, feel free to email me at sbranson@kdins.com, and we'll be answering the new questions at the end of today's session. And if we can't get to them, we'll email you your answers or we'll give you a call. But welcome, everybody. And Kevin, let's see. The first question that we're going to be starting out with is, a D&O policy is called a wrongful act policy. What exactly does that mean?
Okay. First of all, I guess, good morning. Good morning, everybody. Well, I guess it's afternoon in some places, huh?
Yes, it is. Yeah, it's 1 o'clock on the East Coast, so
Okay.
Morning in L.A., though. How's the weather out in L.A., Kevin?
Oh, you know what? It should be nice today, but it's been really, really hot. But hopefully it'll be pretty good today. I'm looking forward to these questions here, because they really have some really, really good questions and more in-depth questions than we had last month.
Mm-hmm.
Like this first one about the wrongful acts. It's a really interesting question because a wrongful act is actually what the D&O policy is really all about. Okay, when you talk about the word wrongful act, now this is the definition from the policy, so you got to listen really closely. It means any error, misstatement, misleading statement, act, omission, neglect, or breach of duty committed or attempted, or allegedly committed or attempted by the insured organization or by one or more of the insured persons, and including but not limited to wrongful employment practices. Now, basically what they're saying is that directors and officers liability coverage protects the insured for claims brought against them from any kind of error or omission or any act or anything like that. Because as volunteers of a not-for-profit board of directors, especially in a condominium, their job is to maintain, enhance, and protect the assets of the community association. Now, what the D&O policy does, it protects them when a unit owner or a renter or a contractor or manager is upset because they believe the board is not looking out for what's in the best interest of the association. Then they make a claim against them saying they committed a wrongful act. So when you talk about the word wrongful act, the key word here is the act itself, any act. So even though we talked about any error, omission, neglect, what we're talking about is the word act, any act. Any act the insured is said to have to be committed. It's not like your errors and omission policy or your malpractice policy, which covers only errors and omissions. A wrongful act policy is a significantly broader policy. For example, if a board decides to no longer fund the reserves because it's an active adult community, everyone's in their 80s, and they decide that they don't need to have a reserve account, they have a special assessor they need the funds. Well, a person can come back and sue that board for saying they committed a wrongful act because they should fund the reserves. And that's what we call the D&O claim. That's why the word wrongful act is so critical and so important.
Thank you, Kevin. And now we have a question that's come in from Indiana, which I believe is the Hoosier state, I believe. What is a duty to defend policy, and why is that important?
Okay, a duty to defend policy. Our D&O policy is what's called a duty to defend policy. And what that means is that the insurer, the carrier itself, has a right and duty to defend any claim covered by this policy, even if the allegations are groundless, false, or fraudulent. Now, the other type of policy is what's called a duty to indemnify policy, where the defense costs itself are indemnified once the case is settled. And only the defense costs associated with the D&O allegations are indemnified, not the other allegations. So, for example, if you have a duty to defend policy and there's 5 causes of action, the duty to defend will defend the entire thing, 100% of the claim. Where a duty to indemnify, there are 5 causes of action. They will provide coverage for the breach of fiduciary duty, but maybe not the dishonesty or the intentional acts or things like that. So the duty to defend policy is a lot broader and a lot better than the duty to indemnify policy.
So you get much more coverage.
Yeah, that's what we're talking about, much more coverage because you're not paying the expense up front. The duty to indemnify policy means you have to defend it yourself, and then you're reimbursed as opposed to having the whole thing indemnified or paid for up front.
Okay, thank you, Kevin. And the next question was just emailed in yesterday. The question is, what does it mean to have a D&O policy that is claims made and reported?
Okay, again, like we talked about, the duty to defend is also a policy is a claims made and reported policy. This means that the policy will only respond to claims that are made against our insured that are reported or made and reported during the policy period. So what we're talking about here, so if a claim is made against the, let's say the president of Happy Valley Condominium Association, and a claim was made on July the 1st, but the policy expires on September the 1st. If the manager of Happy Valley decides that, you know, we're not going to submit that claim, we're going to handle it internally. We don't think that we need to get the carrier involved. Well, now all of a sudden, 3 months later, in December, 4 months later, the actual lawsuit gets filed. And now they're looking for coverage under the D&O policy. Well, the problem is that there will be no coverage because the claim was made during the policy period but reported outside the policy period later on that year. That's why the most important thing in the D&O is that when you have a claim, you report the claim. If you are aware of any claim, you have to report it. One of the biggest problems we see is that people don't understand that it is a claims made and reported policy, and they have to submit the claim in a timely manner. Let us determine if it's a claim or not. The sooner we're notified, the sooner we can get in the process.
Okay, it sounds critical.
That's the critical piece. The timely reporting of a claim is the most important part because if it's not, you'll be denied for late reporting, which is probably our #1 reason for declinations.
Thank you. And the next question, Kevin, is a rather complicated one. It is, what is the difference between pending and prior litigation and full prior acts, and what about continuity of coverage?
Okay, first of all, you want a policy that provides prior acts coverage. Now, when we talk about prior acts, that means that if a wrongful act occurs, so if an error, omission, or any act occurs, prior to such a date of that policy, you're not aware of that wrongful act, that means coverage should be provided. So you have prior acts coverage, coverage provided by any act that happened prior to the inception of the policy. But without prior acts coverage, these claims will be denied because they occurred prior to inception date. So prior acts coverage has to do with when the act occurred and when coverage be reported. Okay? Now, prior acts is critical. Make sure it happens. You have it. When we talk about pending and prior litigation and continuity, they're both very similar in that, in fact, they both provide prior acts coverage. But the difference is that they only exclude known acts, current claims, and pending litigation. That's the key thing. So pending and prior litigation and continuity are similar because they both provide prior acts coverage, which you're looking for, but they do not pick up coverage for known acts, current claims, and pending litigation.
Okay. And Kevin, can you define known acts? What exactly is a known act?
Okay, getting back to the situation where the board failed to fund the reserve properly. Now all of a sudden they know what they've done. They made that decision. Now if somebody, a unit owner, says that, guess what? We don't like you not having a fund reserve. We want you to start funding reserves. If you don't, we're going to cause you some trouble. We're going to file a lawsuit. That is a known act. They know that act may give rise to a claim. That would be excluded under either continuity or pending and prior litigation.
Thank you. And you discussed claims quite a bit. Speaking of claims, Kevin, we received this question on our LinkedIn page. And by the way, I just wanted to mention that we have a Facebook page, a LinkedIn page, and we also have a YouTube page where we put our videos so you can view our videos and also these webinars after the fact. But on LinkedIn, somebody wanted to know, as a broker, how do I recognize a claim when it comes in?
And that's again, we're talking about here on the claim itself now. Because if you don't understand what a claim is, then it's hard to report one. So when we talk about a claim, it's basically a written demand for monetary or non-monetary relief. So that letter you get addressed about the board's failure to enforce the pool hours could be a claim. Have to put us on notice. But a claim is also a lawsuit, a criminal proceeding commenced by return of indictment, a formal administrative or regulatory proceeding. These are your HUD complaints, your American Disability Act, or Fair Housing Act complaints. And they usually involve, some kind of non-employment discrimination type claim. So that's your definition of claim. But the key word is a written demand. Once that written demand comes in, have to put us on notice to protect the claim itself.
Okay, thank you, Kevin. And this next question came in from New York. I just wanted to mention that our New York brokers sent in lots of questions. Hi, New York. Are claims brought by employees of the management company against a manager for wrongful termination or discrimination covered under your D&O policy?
All right, now this is somewhat a little bit more complicated because you're talking about a situation where the management company itself is being sued by an employee, where our association, our community association, is our named insured, not the actual management company and the employee. But I guess the first thing we need to do is look at what's the definition of an insured. Who is an insured under our policy? We're talking about the current board of directors, the past board members, committee members, all volunteers acting in the direction of the board. Now, the key thing now is that coverage also extends to the management company, but only while performing property management services for the insured organization and by written contract. So when we talk about that kind of coverage there, is that management company an insured? Well, yes, the management company is an insured, but are they acting at the direction of the board? Are they acting by contract? I don't believe they are. So therefore, I was finding it really very, very difficult for us to say there's coverage in a situation like that because property management services is very, very critical. The hiring and firing of a management company employee is really not part of services provided by property management service contract for community associations. So I would have to say no.
So there's a distinction there.
Yes, that's right.
Great. And Kevin, the next question is also from New York. Speaking of property management companies, another broker from New York would like to know, why would an insured want to extend coverage to the property managers? Shouldn't the property managers have their own D&O policy?
The answer is yes. They should have their own E&O policy. But we have no problem really extending coverage to the management company as long as they're acting in the direction of the board and in writing, by written direction. But also, too, these property managers are agents of the board. And as long as they're agents, they're obligated to indemnify the acts of the manager. So the board of directors of condominiums, co-ops, homeowner associations, they're obligated to indemnify the acts of the manager. Therefore, it makes sense for us to add an additional insured. Now, Sherry, the problem arises is that when a claim is denied because the manager acted outside the scope of his duties outlined in a contract. So the management company itself both need a E&O and a EPLI policy. In fact, we recently denied a claim where the manager was preparing the budget and they prepared it incorrectly and was sued for the error. The problem was that once we reviewed the contract, it got specified that the manager had the authority to prepare the budget, so when the loss came in, coverage was denied.
Okay, thank you, Kevin. And I just wanted to remind everybody out there to email any new questions that you have during today's session to my email, which is sbranson@kdins.com. That's sbranson, B-R-A-N-S-O-N, @kdins.com. Please send your new questions in and we'll get to them at the end. And Kevin, the next question is coming from Oregon. It's, how would an insured versus insured exclusion apply, or an entity versus insured exclusion apply?
Okay, this is one of our big selling points we've had over the past 10 years because we don't have an insured exclusion or an entity versus insured exclusion. What this exclusion does, it eliminates coverage when one insured sues the another or the entity sues one of the insureds. Now, the reason why this coverage is very important is because the association board of directors, they have to act a certain way. it's something called the duty of care and loyalty, and that is in fiduciary capacity. Now, whenever they're in violation of this fiduciary responsibility, a claim can arise against them. Now, the claims are usually made on behalf of the community association. And when that's done, it's excluded by the entity versus insured and exclusion. Or it can be sued by another insured. It could be a board member, a committee member, employee, which could also be excluded by the insured exclusion. See, we see constantly claims where the past board will sue the current board because they didn't like the reserves that were set up or the assessments are too high. We'll see the president fighting with the treasurer. We see insured situations all the time. So it's critical that these coverages will be there as much as possible.
Okay. Thank you, Kevin. And our next question came in from our Facebook page. Do you have many paid claims over $1 million? And Kevin, what was your largest claim that you've seen so far?
Okay, we do see a handful of claims periodically that's over $1 million. You don't see that many of them, but the largest claim I've ever been involved with was a $12 million discrimination claim out of California. It appeared that the documents themselves was written way in the 30s, 40s, and 50s, and were very restrictive in terms of who could live there, who could not live there. So you had a situation where a Hispanic family who was living at the time wanted to make some changes to the property and was told no by the association. Now the Hispanic family went back, reviewed the documents, and they didn't like the way that the document explained that who could live there, who could not live there. It was very, very discriminatory. So they came back, sued the board, and because of discriminatory practices that were in the documents, it ended up being a $12 million lawsuit, which means they had a huge association. They were very, very expensive homes. They had to come back and buy them. I mean, it was really, really complicated. Now, the next case that we had was a $25 million claim, but it was in a master association. It was off one of the small Florida islands. There were 25 associations involved. Each association had to pay $1 million. And what happened was the developer who wanted to expand the island and put more houses on there, more condominium units, but people who lived there said no, fought it, and all of a sudden the developer came in and sued them off for breach of fiduciary duty and a lot of other reasons. And that was probably our largest claim from one master association, I guess.
That's a very complicated one with all the master associations.
Well, master associations are very complicated, and they're the toughest ones to underwrite also.
Mm-hmm. Thank you, Kevin. And speaking of claims, we have a question. What types of claims are the most common that you're seeing? What kind of trends are you seeing in the industry now, Kevin?
Well, when we talk about D&O claims, they're very, very unique for community associations. Because when we talk about our kind of claims, they usually come in the form of non-monetary damage claims, meaning that there are emotional issues more so than they are financial issues. We don't have economic losses in condominiums. You have these emotional situations where they have to spend time fighting over the right to have a pet or their parking spaces. Can they put a flag in the front yard or not? These are the issues that we constantly see, and the key thing is that coverage may not be under most D&O policies. A lot of D&O policies exclude non-monetary damage claims. You have to make sure that that coverage is in there. So when you say, definition of claim is a written demand for monetary or non-monetary damages, you've got to make sure that non-monetary damage is there. So that is our number one area of claims. When we talk about breach of fiduciary duty, that is basically end up being most of your non-monetary damage claims. The boards of directors have a fiduciary responsibility to act. And when they don't act, that's where you have a problem. They come back and sue them for breach of fiduciary duty, which is probably our most common type of claim that we see. That word, breach of fiduciary duty, automatic D&O situation there. The next area, and it's probably our fastest growing area, is the area called breach of contract claims. Now, historically, breach of contract claims were not covered under the D&O policy because to breach somebody's contract is an intentional act. You did it on purpose, so that it really shouldn't be insurable. What we've done over the past 10, 15 years is say that we'll defend these kind of claims. And so breach of contract is something that we see constantly where the board of directors will just cancel a contract. It could be a roofing contractor or an elevator repair person. What we normally see a lot of is the landscaper. They don't like the work the landscaper is doing, so they end up terminate a landscaping contract, they hire a new landscaper, but the old landscaper will come back and say, guess what? You owe us $100,000 for the life of the contract. And so we see these kind of things over and over again. Employment practice is another area. If you have a condominium association that has employees, you have to make sure you have a D&O policy that picks up employment practices. We see the wrongful termination claims, sexual harassment, and discrimination. The claims are very expensive and excluded under most package policies. Now, we also see non-employment discrimination claim, like I said earlier, with the Fair Housing Act and HUD complaints. We see these things constantly. So that's probably the main ones that we're seeing right now. We've seen other things, other types of claims out there. Wrongful foreclosure is a big one because of the economy. So we do see different types of things now more than ever seen before. The key thing here is to make sure you have the coverage. And a monoline D&O coverage will be better off for you in the long run than the coverage that's found in your package.
Okay, thank you, Kevin. And I just want to remind everybody to email you questions to sbranson@kdins.com. And the next question comes from the great state of Texas, where I live. Does your D&O policy have a Fair Labor Standard Act defense sublimit, or is there no sublimit for this coverage?
Okay. When we talk about the Fair Labor Standard Act, we're talking about the wage and hour. And it's part of the employment practice liability section of D&O policies. Do we pick up wage and hour claims? Do we pick up people who weren't paid overtime? It's something that's a new coverage. It's a new area that we're seeing a lot of. So what we did is put a sublimit of $100,000 on it. We're looking at it and see, is it a big exposure? We're not really sure it's not, but we sublimit to $100,000 just to make sure that we provide some kind of defense or some kind of cost involved. So yes, we do, but it is subject to a $100,000 sublimit.
Okay, great. Thank you, Kevin. And the next question is from Rhode Island, which is my home state. And I'll be there on vacation in a week. Kevin, Rhode Island would like to know, what is a developer's declarant of a condo association? How do you cover it?
Okay. Hey, you going on vacation?
Yeah.
Maybe I should check my emails a little bit more often.
Yeah, exactly.
Oh, well, okay. Well, have a good time.
Oh, thank you.
Down this way. Okay, so we're talking about the developer control boards. What we're talking about really is the developer themselves. Are developers covered under your D&O policy? Well, the answer is no. We can provide coverage for developer control boards, but only if the developer is in his capacity as a board member and not as a developer. For example, the board of directors has a job to set the assessments and set them in a way where they can respond to all the bills and the things they have to pay on a monthly basis. So if the developer, as a board member, sits down and sets assessments really low, and all of a sudden the new board comes in and has to sue the developer because the assessments are not high enough or they didn't do their job, then that's one thing. That's one type of coverage there. If they sued as a board member because he inappropriately or set the assessments too low, yes. Coverage may be provided there, but if he sued as a developer because he didn't do the right job as a developer, there's no coverage there. So that's how we handle it. We provide coverage for the developer as long as he's on the board. Once he's off the board, there's no more coverage for the developer. We focus our attention on the nonprofit volunteers who are serving the community association now.
Okay, thank you, Kevin. And the next question is another one from New York. New York has sent in a lot of questions.
Yeah, they're busy out there.
They're very busy. What is the proper way to handle writing D&O coverage for a master association where you may have multiple boards with their own individual sets of bylaws? Interesting question.
Well, it is because, and I'm glad that I talked about that earlier claim, a $25 million claim, because normally that most people want to do is have one policy to pick up all the associations that are out there. And that one policy had a $1 million limit or a $2 million limit. The problem is that if you have 10 or 15 associations in a master association, each one should be written separately with separate policy. There's no reason to put them all together in a master. You're reducing your limit. You're putting a bunch of people together that shouldn't be together. So the best way to do it is to write separate policies because these master associations are very, very complicated. Sometimes you have commercial associations involved. You have apartments. You can have homeowner associations, and condo, all in the master itself. So I would say the best way, easiest way is to write separate policies.
Okay, thank you, Kevin. And now we have some new questions that have come in, some additional questions. Somebody is wanting to know, how is the rate determined?
Oh, okay. Somebody must be out there seeing these new rate increases that we're getting and not comfortable with how we're rating. So it's a very good question. What we do is look at the exposure. We look at the application. We look at the number of homes or condominium units. Look at the number of employees, if they have employees. We also look at the location. We look at the amenities to see if they have pools, if they have playgrounds, what kind of information they have. We also look at if it's a condo versus a homeowner association versus a co-op. Right now, we're looking at those three different things, and a condominium has more exposure than a homeowner association, and a co-op has more exposure than all of them. So everything is really based on what we're seeing, the location. Do you live in a suburban area versus you live in a major metropolitan area? Those are the things we take into consideration, and we just look at and determine what is the best way. What's going to reduce the claims? And can we get enough money in to pay the claims when they come in? It's interesting for a condominium versus a homeowner association. We think a condominium have tougher rules, so you can have more emotional type claims. A condo usually have a larger budget versus a homeowner association. So we can see more contract breaches in the condo. So we look at those things and say, okay, as a result, maybe there should be a surcharge on a condo versus a HOA, or maybe a discount. So we look at all different kinds of exposures, and we determine that because of these exposures, this is the rate we should charge. And we think that's a pretty good way of looking at it.
Mm-hmm. Thank you, Kevin. And I get asked this question quite often: why does Kevin Davis need renewal applications?
Well, and I get asked that question a lot also, because most people say that a 20-unit, 5-story condominium will be a 20-unit, 5-story condominium forever. The problem, though, is that there could be a situation where there are changes, like in employment. One year you have 3 employees, next year you may have 5 employees, or you may sit back there and say, we don't want employees anymore. So what we do is look at the app every 6 years, and we determine if there's been any changes. If there's been no changes, then we rate it based on the previous information, and we come up with the rate, and we don't look for a renewal application, unless it's every 6 years.
Okay. And can an agent sign the application, Kevin?
Well, we rather have a board member sign or the manager, because they know what's going on in the association. There's warranty statements on the application, that information that may give rise to a claim. And so if the agent signs it and he's not aware, and we come back and decline a claim because information wasn't reported correctly, then the agent themselves can suffer from an E&O exposure themselves. So we'd rather have the insured sign the policy, sign the application. It makes a lot more sense for us.
Mm-hmm. And here's the $1 million question. This one also came in on LinkedIn, on our LinkedIn page. And I just wanted to remind everybody, if you have additional questions, please email them now to sbranson, that's BRANSON, at kdins.com. Please email your new questions in. Here's the $1 million question, Kevin. Why are the rates increasing?
Oh, okay. That is. And the reason why, because of the $1 million claims, apparently. We are seeing more and more claims. We haven't seen this many claims. We've seen more claims in the past 3 or 4 years than we've ever seen in our program. And we're not writing more policies. It's that we believe the economy is dictating the fact that there are more claims out there. People are not happy living in associations. People living in for a number of years. We're seeing deferred maintenance issues. The claims activity over the past several years have dictated us to increase the premiums by about 10%, or on average about 10%, and we believe they'll continue over the next 16, 18 months.
Mm-hmm. Thank you, Kevin. And we have a new question that just came in from Florida. Are you able to backdate the prior impending litigation date? If not, why?
Backdating the pending and prior litigation date, if you ever decide to backdate the pending and prior litigation date, what you're basically saying is that right now I have a case, I'm being sued because for failure to maintain the common areas over the past 3 or 4 years. I'm being sued. I have a lawsuit in my hand. If I backdate that pending and prior litigation endorsement, then that case right now I can submit it to my current carrier. But I have knowledge of that claim. I have knowledge of it. I know what's going on. So when you backdate it, you're saying that it's okay to submit a claim that you have knowledge of. So it's one thing to backdate knowledge. Okay, we pick up information and knowledge that they have no knowledge of, or situations or acts they have no knowledge of. What we want to exclude is knowledge. If you have knowledge of a situation, anything that may give rise to a claim, that is what should be excluded by the D&O. The old D&O policy is the one that picks up those kind of situations. The new ones, we don't want to pick up. We don't want to walk into any burning buildings. And when we backdate the pending and prior, what you're saying is that it's okay to walk into a burning building.
That makes a lot of sense. Thank you. And Kevin, a broker is wondering, I would like to have accounts on direct bill. Is that possible?
Sure. Yeah, we can do direct bill. Contact your underwriter, tell them you want to set up a direct bill on these accounts, and we have no problem setting up where the premium is billed directly to the association, and it saves you time and energy to the agent. So no, we have no problem doing that at all.
Okay, great. And we talked about claims quite extensively earlier. A broker is wondering, would the premium rise once a potential notice of claim is received?
I'm glad somebody asked that question, because what happens is a lot of times we hear that the insured or the manager is afraid to submit the claim because the rates will go up. Well, the rate's not going to go up because of a potential notice of a claim. The rates go up because of defense costs that we attribute to, or judgment. So once a claim comes in, you start paying dollars, and then all of a sudden the rate will go up. Now, rates may go up anyway because the rates are going up, but not because of potential claim.
Okay, thank you, Kevin. And now the Florida broker that sent the prior question in has a follow-up question to that. She wants to know if there is a no-loss letter or claims history that states there have been no losses, would we be able to backdate the prior and pending litigation date?
Boy, somebody really likes that pending and prior litigation.
Yes, they do.
I tell you what, let's look at it.
Okay.
I'm going to look at anything situation. The key thing is you don't want to walk into a burning building.
Right.
So that if there are situations out there that may give rise to a claim, they have knowledge of it. You don't want to walk into a situation like that. And that's the key. If we can find out a way not to walk into that type of situation, we'd be glad to work with you in those situations like that. But the key thing is that when you start backdating pending and prior, or continuity, or prior acts, then all of a sudden you're backdating things, you're walking into situations where the claim's already made. Why keep coverage in effect if all you can do is sit back there and send in an application and say, please issue my policy, backdate the pending and prior, there's no claims, and all of a sudden you get a situation where they had knowledge of that potential claim, they had knowledge of it, they knew what was going on, and we don't have a leg to stand on. So we can look at any situation. Let us know what your thoughts are, and we'd be glad to look at it. But it's really tough to sit back there and to walk into a burning building.
It sounds like you would be willing to be open to further underwriting and taking a look at it, though.
And that's the key. I mean, one of the things that we've done over the years, and we're open to listening. We're open to looking at different things and being creative and underwrite in a creative manner. We have no problem being open and understanding the situation. The key thing, though, is making sure that we're not walking into that burning building situation.
Just being careful.
Exactly.
Great. And a broker from Nevada is wondering, can you write 3-year policies?
Well, the person from Nevada is very lucky because right now we can in Nevada. We can't in a lot of states, our big states, we can't, like Florida, California, or New York. But the other states, yeah, we have no problem writing 3-year policies, and that's not a problem at all.
Okay, great. And Kevin, you've been in the industry for many years. You have expertise in this industry. What would you recommend for the limit of liability?
Well, I would say the minimum limit is a $1 million. Start there, and then you go up. If you want higher limits, we can do higher limits. We also have an umbrella program that goes over the D&O that can go up to $25 million. So, yes, we can provide the limits that you need. But start with $1 million and then see what happens there. What do you feel comfortable with as the insured feels comfortable?
And the umbrella that we carry does follow form over our D&O.
Exactly, yes.
And that's an important thing to look for in an umbrella.
Yes, that's right. Thanks, Sherry.
Sure. Thank you. Well, thank you, Kevin. Thank you for answering all these great questions, and thank you to everybody out there for joining us today. We had a good crowd, and I wanted to mention if you'd like a copy of today's session, please email me at sbranson@kdins.com. We are also putting our webinars on our website, kdisonline.com, and also on our Facebook page and our YouTube page. Thank you, everybody, and have a great afternoon.
Thanks a lot, Sherry.
Thank you.
All right, take care.
Take care.